We're rolling.
Welcome to the House Dudes podcast, where we invite you to follow us on our journey towards financial freedom using the power of real estate. I'm Jack Haas.
And I'm Josh Koth. Here at House Dudes, we believe in a couple key principles. Number one, the best way to retain information is by teaching it to others. And number two, a rising tide lifts all boats. We're not competitors, we're a community. So let's get into some real estate investing.
Well, Brett, thank you for joining the show here this week. And I really got to give you a lot of kudos for being so flexible with me here, because I know that we had to reschedule this once, and I appreciate you being available here today.
Hey, Jack, it's my pleasure to be here. No problem. I have 5 kids. My world is called flexible. That's what I do these days. Young kids too. So you got to just be able to move and adapt.
So, this is going to be a special conversation because we haven't had a lot of tax experts on, and I don't know if you like being called that or not. But why don't you give a little bit about a little background of how you got into this and what you do?
Yes, thanks. So, a tax expert is probably more for like the CPA or tax attorneys. I like to say those guys are the brain surgeons. I'm more of just like the nurse, and I'm going to take your pulse and maybe check you in for surgery before you have something done. But yeah, my background is one of commercial real estate investment and brokerage. I started in 2006 at Marcus and Millichap while I was still in college, and I learned sort of everything that has to do with apartment buildings and buying and selling and operating and owning through either investing myself or helping my clients do the same. Along the lines, we learned a strategy called a Deferred Sales Trust in about 2009. And from that time, I've studied and focused on that strategy as an alternative or a backup plan for a failed 1031, and have now launched the company here, Capital Gains Tax Solutions, to educate as many people as I can about it.
Yeah, so let's start there. What could you define, like, what is a deferred sales trust, and how does that work?
Yeah, and it's a tax deferral strategy, sort of like a 1031 exchange, if any of your listeners know about that. It's based upon IRC 453, which is just known as a seller carryback or seller financing, is maybe what your listeners would know it as. So it's with the deferred sales trust, we call it a manufactured installment sale. We just add an additional trust to the equation to make this work. But essentially, anyone trying to defer taxes on the sale of a business, primary home, commercial real estate, artwork, or collectible, they can use a deferred sales trust as opposed to a 1031 exchange, which is very rigid and is really just for investment properties.
Sure. So since this is a different strategy than we've talked about in the past, is there any additional benefits, especially regarding additional tax savings there?
Absolutely. I like to call the 1031 exchange the hammer and the deferred sales trust the screwdriver. And each of them have their own role and their own benefits versus the other. With the 1031 exchange, let's start there as a kind of a context and for tax deferral. So you can trade, let's say, a duplex for a fourplex, or a fourplex for an 8-unit, as long as it's equal or greater value is really the key here. It doesn't necessarily have to be a number of units. But let's just say you had a $500,000 property and you've owned it for, let's say, 27 and a half years. It's fully depreciated. Say it's an apartment complex, and you were to sell it today. If you don't do a tax deferral strategy, you're going to be hit with somewhere between 30 and 50% of the gain being wiped out by state, federal, Obamacare, and depreciation recapture. So we always start with what is the depreciation and what is the capital gains tax that you're facing. And then from there, maybe a tax deferral strategy would be good. So people do 1031 exchanges to defer the tax so they can earn more wealth. Well, the deferred sales trust is just an installment sale, but the key benefits are that you don't have to go back into real estate at all, but you can. But the key is you don't have to go back within a short period of time. So the 1031 exchange, the intent is to do tax deferral, but the challenge is you have to do it within 180 days, which too often for so many more of my clients in the past meant they had to overpay for properties. They're selling in a high market, and 180 days later, they're buying in a higher market. And so we call this the sell high, buy higher strategy, which we don't think is a very good strategy. We think the sell high, buy low is the ideal strategy. We call this optimal timing. So the Deferred Sales Trust solves all of that, and that you don't have to go back in and within 180 days. In fact, you can go back in 5 years from now or tomorrow or whenever you want, all tax deferred. And the next part is this: you can have a new depreciation schedule. So one of the number one reasons to own real estate, Jack, is to have the depreciation offset the income that's coming in. So let's just say for $100 of rent that's coming in, perhaps you can write off $10 of that against the property. Therefore, although you're receiving the $100 in cash flow, $90 is being taxed. So that's one of the key reasons to own investment in real estate. Now, if you own it long enough, your depreciation gets depleted. And as it gets depleted, you have less and less and less of that. And that's why you do 1031 exchanges to try to get more. But again, the depreciation schedule travels. You can only get more if you buy a brand new property. If you only get more if you do an exchange and buy an extra bigger amount to make sure you get the actual more depreciation. So I'll just give an example. So $500,000 sale again, let's say you're fully depreciated. If you do a 1031 exchange on that $500,000 deal and you buy an exact $500,000 deal, you have no depreciation. Okay. Now, if you buy a $1.2 million deal with that $500,000, now you have $700,000 of depreciation, right? Minus the $500,000 that you've already used. Right. So the solution to that is the Deferred Sales Trust. If you buy that same $500,000 deal through the Deferred Sales Trust, you're getting a brand new $500,000 depreciation. And here's why. A 1031 exchange, the depreciation travels. IRC 453, you're not traveling the depreciation. In fact, you're parking the money and then you're partnering, forming a new LLC, which you're going to buy the property, which gives you a brand new depreciation. So I'm going to pause there because you might have some questions there.
Yeah, well, there's quite a few questions there, but one of the big ones is that on the face of it here now, it's almost sounds too good to be true. Like what type of person or situation is this a good fit for? I mean, we always see 1031 exchange as the default for any of these type of transactions. So this is kind of a new concept here. Yeah,
let's give you a little bit of demographics and some of the profiles for our clients that have used the trust. So according to the American Bankers Association, there's about $17 to $20 trillion, which will pass from one generation to the next in the next 20 years. And this is known as the baby boomers. And it's known as the largest wealth transfer in the history of the planet that we know of. And it's happening right now. Okay. And the challenge is they're faced with 30 to 50% of their gain being wiped out by, again, capital gains tax, depreciation recapture. And in fact, there's 77 million baby boomers in the U.S. alone. And every single day, there's about 10,000 of those are turning 65. And they've made their wealth, Jack, right? They've worked hard for 20, 30, 40, 50 years. They've invested blood, sweat, and tears into their business, into their real estate. And they are ready to retire and or ready to have some liquidity, some diversification, right? To be more passive, not so active in their commercial real estate holdings. So I'll give you a live deal that just closed about a month and a half ago. It's a gentleman named Peter. He's out of Marin, California. He's a longtime real estate broker. Has done lots of 1031 exchanges. He's driving into South Sacramento, which is a very tough neighborhood, fighting traffic, okay, banging on 18 units to try to collect rents, evictions, unit management issues. I mean, it's just really intensive. Okay, intensive for his time and energy. So he decided to do the Deferred Sales Trust, and I said, Peter, why? He said, well, Brett, I didn't want to trade 18 problems. I already have 18 problems right now. I didn't want to trade for 36 problems.
So you were talking about Peter.
Yeah, so I was talking about Peter. And so for his scenario, he had about a $1.8 million sale, and he had about $500,000 in debt. And he had already gone through the 2008 crisis, and he almost lost everything. And he was just tired of doing 18 units, and he didn't want to trade for 36 units. He didn't want new toilets, new trash, new liability. He actually wanted to pay off all of his debt, have liquidity. Here's the key, have diversification. Okay, which we'll talk about here in a minute. But essentially, he put all the proceeds into the trust. So now he has 1.3 in the trust. He deferred the $500,000 liability that he had, and he paid off the $500,000 debt he had. And now he's sitting what we like to call on the sidelines. Okay, he's in stocks, bonds, mutual funds, conservative allocations of his choosing, because the stock market, as we know it, is also pretty high right now. And I'm an investment real estate owner and investor by nature, since I grew up with my dad in the Bay Area building custom homes. So we don't we're not very high on the stock market, but it has its place, right? And as long as you can diversify and put it in some safe instruments, but that's another conversation. But the point is, he is waiting because he doesn't want to overpay for a property. He'd rather sit on the sidelines, make lower returns and some safe instruments than overpay for a property, stay in debt, and have to deal with all the management all over again, or have to hire management. So he goes, Brett, I didn't want 18 problems. I didn't want 36. I'm so glad I had the Deferred Sales Trust. I have so much more time and energy to spend with my wife, travel, do whatever I want instead of fighting traffic to go collect rents.
Sure. So, I'd even guess that some people would even be as bold as saying, is this legal? I mean, it sounds like I'm going to guess that some people would even ask that, but could you talk about
Of course, and they should
little?
ask it, Jack. Sorry, you finish your thought?
No, go ahead. And then I'd like to even talk a little bit then also about, I'm going to guess that, you have a company that specializes in this. I mean, they need some help managing this piece of their portfolio. How do the fees and how do you, I'm sure there's a lot of record tracking and everything else that's going on here.
Yeah, let's finish with a few benefits, and then we'll touch on the legality, the cost, and the ideal kind of client.
Sure.
And so you get a new depreciation schedule. You get optimal timing. You get to pay off your debt. You get to have what's called liquidity, meaning if you're in stocks, bonds, and mutual funds, and for Peter's deal, it's $1.3 million. If he wants to cash out of all of it tomorrow, he can and pay the tax. Mm-hmm. If he wants to cash out small portions along the way, he can. We call that trade plus 3, meaning you just put the order in, and in three or four business days, the cash is sent to you. Now you're going to pay the tax on that amount that you receive. Versus an illiquid asset, such as a primary home, business, or commercial real estate, they could take 3 to 6 months to sell or do a refi. Mm-hmm. Right. So now single family homes, it's quicker, right? And it's maybe a little more liquid, but the point is it's based upon somebody else giving you a loan or giving you funding. So a lot of these baby boomers are looking for the retirement. They're looking for the liquidity. They're looking to diversify. The other part of the diversification, which I think your listeners will like, is the ability to diversify within commercial real estate. So once the 1.3 million is in the trust, which it is now, up to 80% of the funds can be used to go buy a brand new deal or go do some house flips. Mm-hmm. So for example, we call it the go fund yourself. By partnering with your trust, you don't have to do equal or greater value because we're not doing a 1031. You could use that to go buy your house flip for $150,000, use the other 50 to improve it, sell it, and what do? You move all the funds back in and you go do it again. You go do it again. You go do it again. At any point, you need to have 20% sitting in kind of we call it the reserve with liquid investments. But you're doing it optimal timing. You're doing it when you find a deal, not because you have to have 180 days and 45 days to identify it. The other part of your listeners might be interesting is some of them own multiple single family homes. And one of the biggest challenges for multiple single family homeowners is trying to time a sale when all of them sell at once to do this 1031 exchange perfectly, right? Which honestly really doesn't work out. Most of what I've heard. The only way it really works out, practically speaking, is if you take a discount of 20 or 25% to an investor who's going to buy all of them as a pool, and then you go to your 1031 and then you do it, right? Mm-hmm. The Deferred Sales Trust is perfect because we solve that completely, where you can sell each property, and ideally you're going to sell it to a primary homeowner, right, who's going to pay that extra 20% more. And then you're going to move slowly, one trust, you're going to move slowly, let's say there's 20 houses into the trust.
Right.
It's your own timing, your own pace, right? And now you have an extra 20% already there. You're deferring probably, let's say, 35, 40% there. And now you have this pool of money of which some of your listeners might want to go buy 50-unit apartment complex, right?
Sure.
And so now we've just consolidated. We've paid off the debt, and we've given them optimal timing, which is the number one way I think you make money in real estate is timing. You make it on the buy. You make it when there's blood in the streets, right? When there's foreclosures, when there's a value at play. And by the way, you can find deals in every market. The key is, do you have enough time to find it?
Right.
So that is the liquidity piece. That is the diversification piece. Also, they might say, hey, Jack, you have a portfolio of deals. How about I give you 100,000 of that 1.3? And how about so-and-so over there who focuses on mobile home park? Let's do that one. You don't always have to be your own, right? You can truly be passive in this, and you can go with trusted people who own commercial real estate. And let's walk quickly how that works. So you form an LLC, Jack. Let's imagine it was your deal. And you fund, let's say, $500,000 into this brand new LLC, of which you're the managing member of. Okay. You set up an 80-20 partnership.
Sure.
Okay. Now, but the key is the trust put up $500,000. They put up 100% of the down payment. Okay. Now, with that amount, you can go invest in commercial real estate or a new business venture, or first trust deeds is really flexible what you can invest in. And then what happens? Well, you pay back the preferred return to the trust. Okay. We typically mirror the note. By the way, most of our notes go for 10 years. At the end of 10 years, you can renew for 10. It can pass on to your kids. The idea is to pay the tax the second day to never and just live off the cash flow and pay ordinary income on that. Most of our notes earn 8%. After fees to the trustee and the financial advisor, you net about 6.5%, just depending on the size of the deal.
Sure.
Okay, so now you're receiving the income from the deal, and the trust is receiving the income back from the LLC, of which then it can pay you as well. So you're essentially using the trust to fund new purchases at optimal timing. So I'll freeze there because they might have some questions, and like you said, we don't want to get too much into the weeds.
Yeah. So can you go into a little bit more detail then about that piece of it? I was going to ask you how people actually get paid, because typically when I've seen some sort of trust type scenario, all of the money or the proceeds have to go back to the trust, but you basically have a way in which the individual can earn some of this by having that. Is it via that other LLC, that exterior LLC?
So taking the LLC out of it, if you just put it 100% with a financial advisor, by the way, you can choose your own financial advisor. Okay. And we have thousands of financial advisors across the U.S. who are strategic alliances. As a trustee, I can never move the funds. I can only sign off and with the note holder's signature. But the point is, you receive a note payment. You've literally done a seller carryback with the trust. So again, let's imagine it's the $1.3 million, which is say it's your deal that you just sold. The $1.3 million is sitting in the trust, and it was a note, and you have a note, and the note determines the payment. Now you may say, look, I don't need any of that income right now. Let's just let it compound, which we have some clients do that, which is unique in that you can let it compound on top of itself. Therefore, you're not receiving the income. Therefore, you're not paying the tax right now. It's all deferring on top of itself. But you may say, you know what? I like to take interest-only payments. After the fees, let's just take the principal and balance. Okay, and let's just say that's around 6.5%. You can pay ordinary income tax on that. Practically speaking, how it works is there's a bank and there's these investments. And all the money goes from escrow to the bank. And then from the bank, it goes to the investments. And the investments produce a return, which goes back to the bank. And the bank makes a note payment to you once a month.
Sure.
So you can skin that note any way you want. You can do fully amortized. You can do interest only. You could do, and every 6 to 12 months, you can kind of do what's called a refinance. Doesn't cost you anything additional to refinance, but just based upon your needs and your risk and what you want to do, that can be adjusted.
Sure. Okay, that's really interesting. And then there really isn't any limitations on how you can. Is there any limitations or rules on how you can use those funds?
Yes. So you can't go into a primary home. Same reason you can't do a 1031 to a primary home, because that's called constructive or actual receipt of the funds.
Right.
You also can't do day trading yourself. You need to have a third-party financial advisor. Okay. Also, this is where my role comes in. I'm the trustee. The trustee must be a third-party, unrelated trustee. So the financial advisor needs to be unrelated. It needs to be a third party. Same with the trustee, unrelated, third party. And also the financial advisor can't be the trustee. We call this the balance of powers, which keeps the whole integrity of the trust working. So you have the financial advisor, you have the trustee, you have the tax attorney. Each of those entities can't be one another. And then there's a note holder, you in the middle. Okay. And, but yeah, that's it. And then you can buy and trade again, whenever you want to. So does that answer the kind of the basics? And we can get to the legality part and the track record as well, if you're ready.
Sure. Well, let's start with is there a minimum amount that a trust can be at? Like, is it 50,000? Is it 100,000? What's the minimum?
Great question. The better one would be, what's the best ROI, the return on investment? Is there a deal that's too small that doesn't make sense? Okay. Sure. And so we found that for every $100,000 in actual liability, that's the check you're going to write. Not just your gain would be probably about $300,000 gain, right? To get you about $100,000 in liability. So the liability is the state, federal, Obamacare, depreciation, recapture. If that's $100,000 or greater, first step. Second one, for every $500,000 of proceeds.
Sure.
Okay, so let's give an example. If you had a $10 million deal, Jack, and only had $100,000 of liability, it's just pay the tax and walk away with the 9.9, right? Now, if it's $10 million deal and you have $4 million in tax, Jack, talk to us, right? Because that's serious. That's a serious 40% of your gain. Now, if it's $500,000 and it's $100,000, okay, good. So those are kind of the ratios there. Our average deal is about 2.6 million, and we're deferring somewhere around $350,000 to $500,000 in liability. Okay. We just did a deal last week. It was a $3 million sale, and she has a primary home in Cupertino, and she deferred about $350,000 in tax, but her net was about 1.8 because she had some debt on that. So she knocked off that debt. She put the 1.8. So so every deal's a little different. We have a deferred sales trust calculator that you can answer 12 questions online. It's totally free. Gives a side-by-side comparison to figure that out.
And I'll make sure to include that in the show notes. So let's jump back to the legality and a few of those other questions I had previously there.
Yes. And by the way, that's the number one question you should be asking, Jack, or anyone else on this call, of us or anyone else who brings you a strategy for taxes. You want it, or any strategy that per se, but especially if it sounds too good to be true, right? Because that's the number one thing we get. This seems like it's too good to be true. We know it seems like your CPA would have told you. It seems like you would have heard this years ago, right? But let's just start with the legality and the track record. Okay. So first of all, the first question you want to ask is, what is the tax code, right? So someone brings you a new strategy. What's the tax code? For the Deferred Sales Trust, it's IRC 453, which is just an installment sale, which your listeners probably know of. If they don't, your CPA definitely knows about it. Well, what's that law? Well, it goes back to the 1920s. Installment sale, 1031, those are the two main tax deferral strategies, okay, that people use. Two main ones. And there's some charitable stuff, but those are the two main ones. So 1031 goes back to about 1954, and then it really didn't become popular until the Starker Exchange case. And then so like the 80s, the 90s, it came, really got popular. But installment sale, 1920, okay? And you've probably done installment sales yourself, Jack. Like, I mean, it's not a complex law. It's very simple, tried and true. Okay, that's the first thing. Okay, so the next one is, well, okay, so you're doing an installment sale, but how many of these have you closed? Well, thousands of closes. Okay. How long have you been doing it for? 23 years. Okay. The next one is, well, how many of those thousands of closes have been audited by the IRS? The answer is 14. Okay. Of those 14, what was the largest one? It was for over $100 million, a deal in California, commercial real estate property. Okay. Have there been any issues with the IRS? Not one single issue. The next question you want to ask, well, are there any live pending court cases or audits going on? No. When was your last audit? Earlier this year, it was a formal audit of the entire structure, of the tax attorney, of the co-founder of the Deferred Sales Trust. And in fact, that same formal audit wasn't tied to a case, happened in 2008. And it was the exact same conclusion, not one single issue. In fact, this is what they said, Jack. They said, look, you guys are just doing an installment sale. Now, you're being creative on how you're doing it with this third-party trust, which is in it for business purpose, which can make a fee, but you're just doing an installment sale. The next questions your listeners might be asking is, well, why does the government allow this? It seems too good to be true, right? Well, they allow these tax incentive loopholes, legal loopholes, to incentivize people from putting all their money under their mattress, right? They want to keep it in stocks, bonds, mutual funds. They want to keep it in real estate. Why? Because that spurs economic growth. So it's the study of macroeconomics, which states if I can keep more money in the open marketplace, capitalism, right, it's actually going to net more tax dollars in the long run versus taxing somebody up front, or not giving any tax deferral options, because most people would never sell, right? So you don't get the attorney fees, you don't get the realtor fees, you don't get the construction fees, you don't get people up, expanding their businesses. So these are all built in to actually spur the economy. The second reason is the government doesn't want to be in the business of being a lender. Okay, in fact, part of the 2008 crisis was some of the government and was tied to some of the banks, right? And some of that stuff. They don't want to be in that business because that puts everyone at risk. So one way that can incentivize and to hedge against that is to say we need to allow American citizens to be lenders of their own, be their own bank, right? Right. Okay. The next one is, well, how do I know the funds are protected? All right. How do you know this trustee that I've never met, Brett Swarts, I'm here on this podcast, is not going to take my millions of dollars and go to Mexico? Okay. First of all, you have 24/7 access to view the funds. Second, our funds are held at some of the largest banks in the world: Bank of New York Mellon, Charles Schwab, TD Ameritrade. Next, the funds only ever move with the note holder's signature. Okay. So Jack, if you had the $1.3 million deal and you owed $300,000 in tax and you paid it and you walked into a financial advising office and said, here, manage my million, do the funds move without your signature? No. Now, if you walk into that same financial advising office and say, hey, talk to Brett, I want you to manage the trust, or let's get this all connected, the 1.3, do the funds move without your signature? No. So it's the exact same thing. Now, it does take a trustee. I have to sign off on it because that's my role. I want to make sure that everything's protected. But you are the ultimate creditor. It's the same reason a bank gives you a loan, Jack, right? Mm-hmm. They say, yeah, go buy your house, Jack. You be the owner. But we have a loan. They're not concerned you're just going to sell that house and not pay them back. Why? Because there's protections in place and they have rights, right? Same exact thing, okay? So that's the fun part. The next one is just get to know us, right? It all seems too good to be true, but get to know us. We want you to bring in your trusted advisors, your CPAs, your tax attorneys. Those are the brain surgeons, your trusted people, financial advisors you've been working with for years. Bring them in. In fact, that's how a lot of people join us. Once they learn about it, hear about it, they join us and they offer it to all of their clients. That's how we organically grow. But we want to tell you this. We don't get paid unless you do the deal. So a lot of tax attorneys and even consultants, they'll charge you just for hourly rates just to talk. We don't charge anything. In fact, we will set up all of the trust, everything in place, get all ready to go. If your deal doesn't close or for some reason you choose not to do it, no problem. We're not pushy salesmen. We just say, here's your options. A, B, or C. What do you want to do? And if it happens to work out, great. So, but if you do close, we'll talk about fees here at the next, then yeah, we actually get paid. But really, my role is just the nurse, right? I'm not the brain surgeon. The brain surgeon is the tax attorney and the CPA. And I would tell your listeners this too. Your CPA or tax person may not be an expert in brain surgery. They may be a good knee surgeon. They may be a good general practitioner, but just because they haven't heard of it or don't maybe understand everything about it doesn't mean the brain surgeon has ever lost a patient or anyone's ever gone to jail, right? And that's the key. Has anyone ever died? No. Has everyone ever got the taxes were triggered? Nope. Has anyone ever went to jail? No. So we also encourage you to, push back on the CPA, even though they're like, oh, I'm not sure, because they're not necessarily incentivized to say yes, but they're not trained in this. Like all our tax attorney does is these deferred sales trusts. In fact, he's the number one installment sale attorney in the U.S., and this is what he focuses on. So, but that being said, we do want to bring him in. We want to get their blessing, and we want to make sure that everyone is as comfortable as they can be with the structure, who we are, and why we do what we do.
Sure. A lot of people put money in a trust because of the legal protection associated with it. Is that something that I know it's probably a lawyer question, but is there a lot of benefit associated with the trust you're talking about regarding that asset protection?
Yeah, so on asset protection, great question. So depending on what state you live in, there's some extra opportunities for that. But just so your listeners know, this note becomes an asset inside of your living trust, okay? And it passes in your living trust. And I'm just and my role is just the trustee of this small deferred sales trust, which is part of your bigger overall living trust, which you have a trustee on as well eventually, right? So the deferred sales trust in and of itself doesn't necessarily have asset protection per se, okay? However, depending on the circumstance, depending on what I've heard some of the brain surgeon tax attorneys talk about, the income may be subject to judgments, right? But the actual, again, every circumstance is a little bit different, may not be subject to, that's protected, right? So let's say the $1 million principal's in there, and 6% is paying out. They may not be able to get to the $1 million, but they could get to the interest. Does that make sense? Yep.
No, that does make sense. So talk a little bit about the fee structure. How do you get paid? How do we get paid, right? So there's 3 sets of fees. Okay, we'll start with the tax attorney because that fee is a one-time fee. It's 1.5% on the first $1 million, and it's 1.25% on anything above. So let's imagine it was a $3 million deal. On the first $1 million, be 1.5%, and then the $2 million remaining be 1.25%. Now this includes legal and tax structure, and includes audit defense for the life of the trust. Okay. Second set of fees is to my company, Capital Gains Tax Solutions, as the trustee fee. We get paid at close of escrow, and then once a year at the anniversary, based upon the assets, the amount of value in the trust. Okay, so it's 50 basis points. It's a half of 1%. Okay.
As long as you're 100% with the financial advisor in securities. Okay.
Mm-hmm.
And let me jump down to the financial advisor, and then I'll jump back up to the trustee. So, well, what's the financial advisor charging? Well, somewhere between 50 basis points and 130 basis points. It just depends on how and where the funds are invested. Okay.
Right.
And whether or not you use one of our strategic alliances, which charges even a little bit less. So just call it 1.5 generally is going to be the recurring fee, for trustee plus financial advisor, give or take. Now, if you go into real estate, you're like, you know what, Brett, that's great. I like financial advising, but I actually want to go back into real estate. Well, for that amount that you send out, remember, you can do up to 80%. Let's imagine it was a $1 million case. So $800,000 goes out to an apartment complex over here. Mm-hmm. Well, now the financial advisor is no longer managing that, right? So he's not getting paid. But the trustee fee does double. It goes from 50 basis points to 1 point. So most of our notes earn 8. And remember in the beginning, I said after fees net about 6.5. That's how we kind of get to that number, right?
Sure.
But remember, when you're owning that apartment complex, let's say you're earning 10, 12, 15%. After you pay back the 8 to the trust, which is going to pay you, that upside is 80-20. It's 80% to you, the note holder, individually, and only 20% to the trust. Plus, you just got a brand new depreciation schedule, right?
Sure.
Now you add value to that $1 million deal, and now it's worth 3. What happens? Well, same thing. You pay back the preferred return, and then 80-20. 20% goes to the trust. The other 80 is to you. However, you may want to roll that into the trust too, right? Sure. And then we call that rinse, wash, repeat.
Sure. Yeah, this is really interesting. Like it sounds like you've got a way to really maintain control and you don't have a lot of pressure associated with, because I know somebody right now who's going through the sprint of the 1031 exchange. They're trying to identify that property and get it under contract. There's all of these requirements in such a compressed time. And what's unfortunate is that, based on where I live, our buying season is always cyclical, especially in winter. And the best time to buy in my market is the dead of winter, because that's when people are experiencing.
They're going to sell in the dead of winter. There's something happening now.
Yeah. So unfortunately, they're not going to have that luxury. They have to act within a certain amount of time. So
you hit it on the head. We want to free people from feeling trapped by capital gains tax. We want to free them from feeling trapped by the 1031. We want to eliminate the need for the 1031. Unfortunately, the investment commercial real estate world, it's kind of like a religion. And one of their doctrines is the 1031. Mm-hmm. And they're just so married to this doctrine of 1031 that they don't realize there's another really good doctrine right here that's been around even longer. It's called IRC 453. But they think of it in a traditional sense. In a traditional sense, it's not that attractive because the note holder is going to pay you back pretty quick. You're not diversified. You're tied to that person. But as soon as they, connect with us, learn this, understand it, and it's like riding a bike. The first time is going to be a little bit wobbly, but so was their first 1031 exchange. But when you ride the bike once or twice and you have trusted team members around you, okay, all of a sudden you're flying, right? And then we just don't want anyone to feel like they have to do a 1031 anymore. And then remember, it works for a business. A business owner doesn't have a 1031 option. I've yet to find anyone do a 1031 with the business. So we have dentists, veterinarians that sell, and if they don't meet us, they pay a couple million in tax. Right. And you're like, whoa, what were you going to do with the money? Well, I was going to give it to my stockbroker, or I was going to invest in some properties. Well, would you like to have a couple million more? Yeah, I wish somebody would have told me about it. So business owners is number one. Okay, so circling back to your number one question, like, well, who is this pretty good for? Number one is a business owner. Highly appreciate it. Dentist, veterinarian, tech company, you name it, any company really. Business owner, number one. Number two, high-end primary homeowner, right? Meaning they bought in the Silicon Valley or New York or one of these major, areas on the East Coast, and they bought it 30 years ago for $250,000, and now it's worth $3 million, right? They don't have a 1031 option. They only have what's called a 121 exclusion, which states if you live there 2 of the last 5 years, you have a $250 tax-free or $500 if you're married tax-free. But above and beyond that, they have none. I'll give you two deals. One was in Newport Beach, $26 million primary home sale. I know in North Dakota, there may not be some of those on the beach, but because there is no beach. right?
No.
But the point is, if anyone knows anybody, it works. So $6 million above and beyond their exclusion, they deferred, and they use the Deferred Sales Trust. You can call them. Second one, I'm closing right now. It's actually with the number one realtor in Keller Williams multiple years in a row. He sells about $100 million or so in Palo Alto area every year. And he's selling his $14 million home. We're going to help him defer $2 million in capital gains tax above his exclusion. So this becomes kind of the only game in town for the primary homeowner, really the only game in town for the business owner. And commercial real estate, you have the 1031. And by the way, if you can find a 1031, great. If you can find a deal that makes sense for you, fantastic. In fact, we want you to do that. But if for some reason you can't, we want you to know that we can be a backup plan for a failed 1031, or just at close of escrow, we can help you right there. We can help you just do a deferred sales trust right there.
Sure. So, I have a feeling you and I could chat for a lot longer, but is there any other questions that you wish we would have asked or covered here today?
Oh, I don't think so. It's probably a fire hose for your listeners. So I would just encourage them to just connect with us. We have a YouTube channel. We have our website. We have free webinars. We have free one-on-one consultation calls, right. And just slowly get to know us. Like anything else, you got to take your time to do education. Now, be early though, because someone might be saying, "Well, what are the next steps? I want to really consider this." Well, schedule that call. Use our Deferred Sales Trust calculator to make sure your liability is big enough, and then if that looks good, we get on with the tax attorney and talk. Mm-hmm. Bring in your trusted advisors. If that looks good, you sign a conditional engagement agreement, which is completely conditional. Nothing's owed unless you do the deal. And then we just connect with escrow. At that point, it's just like forming an LLC. We're just doing some paperwork, connecting with escrow. And before you close on anything, you fill out a risk tolerance questionnaire, and that determines for how and where the funds are invested. That's maybe something we didn't touch on, but it's a 2-page questionnaire, and that becomes the constitution for how it's invested. And then we close, right? And then you're living off the income, and then that's it, and people get pretty happy, especially if they're ready to retire and they're just they're just ready to be more entrepreneurial and get diversification and have that optimal timing, which is the message we're spreading right now. So, well, I really thank you for joining me here today. This is really an eye opener, and I hope some people have really taken a lot out of this one and see that there is a very attractive alternative to that 1031 exchange. I will make sure to include links to your website and your YouTube channel and everything in the show notes. I again, thank you. I really value your time, and this has been a great conversation. My pleasure. And again, it's capitalgainstaxsolutions.com for your listeners who are to find that, or search Capital Gains Tax Solutions on YouTube, LinkedIn, Bigger Pockets, or Brett Swarts. And you can find me there too.
Well, thank you again, Brett.
Thanks, Jack.
We've put a lot of effort into providing useful content, and if you found value in the show and have any interest in supporting us with a small donation, head over to patreon.com/housedudes.
And if you have any thoughts or questions, shoot us an email at info@housedudes.com. You can also find us on Facebook, Instagram, and Twitter @housedudes. And if you like what you're hearing, head over to iTunes, subscribe, rate, and review the podcast. It really helps other investors out there find the show.
And remember, massive positive impact requires
massive positive action. We'll see you next time. This episode was brought to you by HouseDudes.com. Do you have time to actively manage flipping and rentals yourself? If so, go for it. If you live in a market that won't cash flow or don't have the time to do all the work, are you just out of luck? If there was a way to participate more passively, would that appeal to you? I'm sure you have questions about how the process works and what to do next. If that's the case, fill out the form on housedudes.com/investors, and we'll reach out to see if you are a good fit for our business. This is first come, first serve, and we will have to stop taking applications when our goals are met. See you at housedudes.com/investors.
I don't like to tell a man what to do with his money, but if you ain't investing in property, then you're dumber than a dummy.
I'm not dumb. I'm smart.
Well, buy property. That's my advice.